Hi there. This is Team F, Sole Proprietors Strategic Analysis. Our team consisted of Morgan Bean, Timothy Dominic, Jennifer Fair, Rochelle Lewis, and Blake Sutherland. And let's get started.
Hi, I'm Blake Sunderland, and I'm going to give a quick introduction into our strategy. So, here at Sole Proprietors, we wanted to be dedicated to staying a step ahead of the competition by offering a high quality product, extensive wide selection, where we set our models and styles to 500 in every single market, including North America, Europe, Africa, Asia Pacific, as well as Latin America. We wanted to ensure that we had a perfect fit for every customer in trying to stay a step ahead of the competition. Our focus was on providing an excellent product, trying to be innovative and strategic across all different markets. And our strategy shifted to focusing more so on the private label towards the latter end of our overall strategic initiative from probably fiscal year 15 throughout 20. Initially, we focused heavily on our internet and wholesale support, and really put a lot of investment into marketing strategies, internet advertisement, and retail support, trying to optimize our overall cost to increase or maximize our profitability. We leveraged our competitive analysis each week, trying to strategize, look at different competition and their overall strategy, where they were focusing heavily, where we weren't, and really try to drive our decision making based off of the overall competitive analysis. And we had to shift and always be adaptive to the competition, specifically in the type of materials that we're using that seem to drive up our overall production cost. As I spoke about previously, our strategic focus was to invest in increasing our SQ rating, reducing our error rates within our production facilities, and increasing our brand image. Early mid-game decision, we decided to avoid celebrity contracts, as the celebrity contract that we did receive early on in the game did produce some positive results, but not quite what we would have expected by having a celebrity endorsement. So we wanted to shift our focus, and our goal was to maximize our shareholder value, specifically through the access and gaining those bids for private label. There were some notifications that we received as far as limitations around a 20% market value or a market hold. And so we tried to maximize that and at least have 20% by being competitively priced and while still maintaining profitability. As we moved through each fiscal year, we wanted to try to continue to reduce our production costs by moving most of our production over to the Asia Pacific market as well as Latin America. And the goal there was to increase the overall margin and net profit in our margin within the products that we were producing. Again, as we went through and analyzed the competitive analysis, our focus was being and shifted to being competitively priced, and the goal was to overall, outperform our investor expectations.
I'm Tim Dominic. I'm going to talk about our analyses components. First, we chose to go with the ANSOB matrix. We have our market penetration. We strengthened our presence across all branded regions. Our internet sales reached $382 million in year 20, compared with $90 million in year 10. Our image rating consistently maintained near the 70s. For our market development, our private labels surged in Latin America. Not as great in other markets, but we did pretty well there. And well over half of our private label bids were competitive. Our product development, initially we focused on raising our SQ ratings toward 9. We achieved 7.9 at the highest, and we invested in branded quality and variety, focusing on higher SQ ratings and trying to maintain profitability. Hello, for our value chain highlights, wanted to talk about first off inbound logistics and operations. We had consistent labor and production cost control in North America and Asia Pacific. We outsourced to low cost regions while maintaining quality. Marketing and sales component, our internet market share peaked at 14% in North America and 12.6% in Latin America. We had a strong online presence reflecting digital marketing efforts. Service and support, we managed to maintain a pretty high SQ rating, around 7.9 at the most, and our image ratings hovered around 70. Our margin analysis, our profit margins improved with efficient production and premium pricing. And wholesale and internet operations contributed to our stable earnings, finishing the entire game at $7.84.
Hey guys. Throughout the simulation, we encountered several strategic and operational challenges, and that's what I plan on discussing on this slide. One of the most persistent issues was high overhead, particularly warehouse and administrative costs, which reduced our profitability. In the early years, we also struggled with inconsistent SQ ratings, which limited our competitiveness and brand image. And additionally, in the Europe-Africa region, we faced significant pricing pressure, which made it difficult to compete effectively. We also missed out on the private label opportunities between years 14 and 17, and due to the low or absent bidding in those years, these missed contracts affected both our revenue and market share. Finally, a forecasting error in year 20 caused us to miss the Bullseye Award, which cost us valuable points in the final evaluation. Operationally, we didn't maximize efficiencies early enough in the game to create long-term costs and advantages. So that is going to be the list of our challenges. So this is going to be our response to the previously mentioned challenges. So one of the major changes was a pivot towards private label sales. Recognizing our earlier underperformance, we began placing more competitive bids and reallocating resources to that particular channel. We also pulled back on high-profile endorsements and shifted that spending towards TQM initiatives and then corporate social responsibility options, which offered a better long-term image improvement results. Strategically, we began redirecting our regional investments, focusing less on underperforming areas and more on regions where we saw higher returns. And then finally, we adjusted our pricing models to remain more competitive while still preserving our margins. These decisions helped stabilize our performance and regain momentum later in the game.
Despite the challenges, our team walked away with some solid achievements that we're proud of. We earned the Leapfrog Award in year 20 for our biggest score improvement, jumping 10 points in a single round. Our final return on equity hit 25.9%, and we finished with a 10.5% net profit margin. Throughout the game, we maintained an A- credit rating, which shows financial stability even with tough competition. We were also recognized for our values, winning the Corporate Citizenship Award in year 18, which reflected our focus on doing business responsibly. Our stock price rose towards the end, and we saw momentum in private label sales and strong regional performance. These wins might not have landed us at the top of the leaderboard, but they did show our progress. We had some strategic wins worth highlighting. North America ended up being a strong region for us, especially in the internet sales segment, where we saw steady growth that helped boost our overall performance. We also made consistent improvements in our SQ rating throughout the game, eventually reaching up to 7.9 stars in some regions. That increase in quality played a big role in making our products more appealing and competitive. Even though the game had its ups and downs, we were resilient, and our stock price reflected that with a solid rebound in the final rounds. Looking back, there were several key areas we stumbled strategically. One of the biggest was our delayed entry into the private label bidding game. By the time we got serious, competitors had already carved out strong positions, and we were left trying to play catch up. We also made use of the market and competitor reports, but we probably needed to dig deeper. We looked at the data, but we didn't always translate it well into actionable insights, which might have helped us respond faster to shifting trends and competitive moves. Another inconsistency was in our investment strategy, particularly with CSR and advertising. Even though we won the Corporate Citizenship Award, we weren't as steady or intentional as we could have been, and that lack of commitment made it harder to build a strong, recognizable brand. Finally, we missed some critical opportunities to build momentum during key growth years. Whether it was cautious decision making or poor timing, we weren't as aggressive enough when it mattered most. These missteps did not define us, but they definitely taught us where to focus next time.
Lessons learned. One of our takeaways was the importance of strategic consistency. We found that switching approaches in the middle of a game made it harder to build momentum and maintain our focus. So we learned that once a direction is chosen, whether it's differentiation or cost focus, it's best to support the direction with every subsequent decision the team makes. Forecasting accuracy was another key lesson. Even small miscalculations create ripple effects across an organization's performance. We saw firsthand how metrics are strongly interconnected. For example, weak branding lowered our investor score, which affected our stock price, which affected our credit rating. And we also saw how influential the image rating can be. Image rating had a direct impact on investor confidence and shareholder value. And this reminded us how important brand perception is in a competitive market. One area where we could have done better is private label. We were a bit slow to act in the beginning, and starting sooner may have led to more growth, especially in the markets we underutilized. And finally, internal communication played a vital role. Our strongest results came when we were aligned and working together, and in a real business setting, we would focus on planning earlier, improving communication, and staying flexible as the market conditions shift.